Hello and welcome. Today we're going to dive deep and deconstruct the essential accounting principles for merchandising businesses. These are the companies all around us, from that local shop on the corner to a massive global retailer. Their entire world revolves around one core activity: buying goods and then reselling them, hopefully for a profit. So here's our game plan for today. We're going to follow a really logical path. We'll start by defining what exactly a merchandising business is. Then we'll get into the nitty-gritty of tracking inventory as it comes in and as it goes out. And finally, we'll wrap up by looking at how we report and, more importantly, analyze the financial results of all those activities. Okay, let's jump right in. All right, first things first. Before we can get into the numbers, we have to establish the fundamental difference between a company that sells goods and one that sells services. This distinction, it's absolutely central to the unique accounting procedures that we're going to be discussing. And you can see the crucial distinction right here. A service company, think of a law firm or a consulting agency, earns service revenue. Simple enough. But a merchandising company earns sales revenue. The big change, though, the one that really alters the entire income statement, is on the expense side. We're introducing a major new expense category called the cost of goods sold. So this big new expense, cost of goods sold, or COGS, as you'll always hear it called, represents the direct cost of the actual stuff, the inventory that was sold to customers. When we subtract this expense from our sales revenue, we get a really critical subtotal called gross profit. Now, this number is our first look at profitability. It's the money the company has left to cover all its other operating costs. Things like salaries, marketing, rent. Trust me, financial analysts watch this number like a hawk. Okay, so we know what makes these companies tick. Now, how do we actually account for the stuff they buy? Let's take a close look at how we track inventory as it comes in the door. We're going to focus on the most robust and common method used today, the perpetual inventory system. The name says it all. The inventory records are updated perpetually, continuously, in real time. The accounting for inventory doesn't just start when it hits the warehouse. It actually starts the moment it's shipped. And that's where these terms FOB shipping point and FOB destination become absolutely critical. With FOB shipping point, the buyer pays for the shipping. And, this is key, they own the goods the second they leave the seller's dock. With FOB destination, the seller pays the freight, and ownership doesn't transfer until the goods physically arrive at the buyer's location. This little detail determines who bears the cost and, importantly, the risk. Now, sellers are smart. They want to get their cash as quickly as possible, right? So what do? They offer an incentive, a purchase discount. You'll see terms like 210 and 30 all the time in the business world. It's a clear offer. Pay your bill within 10 days, and we'll knock 2% off the top. Now, 2% might not sound like a lot, but as we're about to see, the financial consequences of ignoring that offer are pretty staggering. Okay, get ready for this because this is where it gets really interesting. That little 2% discount, by passing it up just so you can hold on to your cash for an extra 20 days, well, you're effectively paying an annual interest rate of 44.6%. Let that sink in. From a financial management standpoint, it almost never makes sense to pass up this discount. It's usually smarter to borrow money from a bank at, say, 8% to pay the bill early and grab that discount. All right, so we've got the inventory in. Now we've got to sell it, and this is where things get a bit more complex. Under the perpetual system, recording a sale isn't a single event. Every sale is really a two-part story. Now listen closely, because this is a fundamental rule. Every single sale requires two separate journal entries, not one, but two. The first one is pretty much what you'd expect. It's all about the revenue. We record the money we're getting, so we increase either cash or accounts receivable, and we recognize the sales revenue we've just earned at the selling price. Easy enough. And right after that, at the very same time, we make the second entry. This one is just as crucial. It records the expense tied to that sale. We increase our cost of goods sold expense account, and we decrease our inventory account to show that the item has officially left the building. This, right here, is the beauty of the perpetual system and a perfect example of the matching principle in action. We are matching the expense directly with the revenue it helped generate, all in the very same period. Okay, so we've spent the whole period, a month, a quarter, whatever it is, carefully recording all our purchases and all our two-part sales. Now it's time to pull it all together and see how we did. And that means building the company's financial report card, the income statement. This report generally comes in two main flavors. This single-step format is exactly what it sounds like. It's super simple. Just take all your revenues, subtract all your expenses, and poof, you have net income. It gets the job done. But the multiple-step format, well, that's where the real insight is. It gives managers and investors a much richer story by breaking down profitability at different stages, revealing key performance indicators along the way. So let's break down that more insightful multiple-step statement. Look at the logical flow here. It's a cascade. We start with our total sales at the top. Then we subtract the cost of goods sold to get that all-important gross profit. From there, we subtract our operating expenses to figure out our income from operations. And finally, we account for any non-operating items to get to the bottom line, net income. Those subtotals, gross profit and income from operations, they tell a detailed story about just how efficient the company's core business really is. But you know what? Just looking at that bottom line, that net income number, it doesn't tell the whole story, not even close. To really understand the health of the business, we need to dig deeper. We need to dissect that income statement using some key profitability ratios. Let's see how these can build our understanding. This first ratio, the gross profit margin, is incredibly revealing. It answers a very simple but very important question. For every single dollar we make in sales, how many cents are left over just to cover the cost of the item we sold? It's a direct measure of a company's pricing power and its purchasing efficiency, all before we even think about things like marketing or administrative salaries. Then we have the profit margin. Now, if the gross profit margin was the first half of the story, this is the grand finale. This ratio tells you what percentage of each sales dollar is left as pure bottom line profit after everything has been paid. COGS, operating expenses, taxes, interest, the whole shebang. It's the ultimate measure of a company's overall profitability. Okay, so we've focused heavily on the perpetual system because honestly, with modern technology, it's what most businesses use. But it's not the only way. It's really important to be aware of an older, alternative method, and also some different accounting rule books that you might encounter, like ASPE, which stands for Accounting Standards for Private Enterprises. The primary difference between these two systems really just boils down to timing. The perpetual system, as we've seen, is like a live scoreboard, calculating the cost of goods sold with every single sale. The periodic system, on the other hand, it doesn't even try to calculate COGS during the period. Instead, it waits until the very end, does a full physical count of all the inventory, and only then figures out the cost of goods sold for the entire period. Now, for those of you who might work with private companies, you'll likely run into ASPE. And ASPE handles things like sales returns and discounts a little differently than IFRS. Instead of estimating returns and adjusting revenue directly, ASPE uses what are called contra-revenue accounts. It creates separate accounts, like sales returns and allowances and sales discounts, that reduce the total revenue. The cool thing about this is the transparency. You see the big gross sales number right at the top, and then you see exactly what was deducted from it. All right, we've covered a lot of ground. We've gone through the theory, the mechanics, the analysis. So let's end with a real-world scenario. Let's put your new knowledge to the test. Imagine this. A company's gross profit margin has been rock solid for 5 years, always between 20 and 22%. But this year, it suddenly plummets to 14%. That's a major red flag. What could cause that? Did their purchasing costs spike? Are they facing intense pricing pressure from a new competitor? Or is it something more sinister, like inventory theft? Your ability to look at that number, ask the right questions, and diagnose the potential causes, that is the true measure of your understanding.